Welcome to this special edition of Financial Friday. It's October 23rd, 2009. He writes about investment hocus pocus, bordellos in Thailand, and duck hunting in Michigan. His website is characterized by images of skeletons doing the dance of death, and he's famous for his ponytail. But he's also famous for advising his clients to get out of the stock market 1 week before Black Monday hit back in October of '87, and for being one of the bigwigs at Drexel, Burnham, and Lambert back in its heyday. Most recently, he correctly predicted the low point of the current financial crisis on March 9th of this year. I am, of course, talking about the one and only Dr. Marc Faber, editor and publisher of the Boom, Gloom, and Doom Report, who joins us now. Marc, welcome.
Thank you.
I'm sure there's a
Pleasure
lot
to be here.
Thank you, and I'm sure a lot of things I didn't say about your past in that introduction.
Actually, I never went duck hunting.
You never?
I went to see animals in Africa and elsewhere in the world.
And so you've written about that, and let me ask you, in the most recent version of the Boom, Gloom, and Doom Report,
Yes.
You do it again. You start out writing with an anecdote about mercenaries in Afghanistan
Yes.
and soldiers for hire.
Yes.
You've obviously not been duck hunting, but you've written about it, and you've written about bordellos. What does this have to do with serious investing?
Well, because if I were an investor, I wouldn't pay much attention to what Mr. Bernanke says and does. He will print money, that is clear. But aside from printing money, there are lots of other factors that will influence investment markets, which include commodities, equities, real estate, art prices, and bond prices. And geopolitics is obviously one of them. And I've written about war cycles before because it's a branch of history that is very important. And every historian has contributed to a war cycle theory.
One of the things that you've also talked a little bit about is this kind of idea of common sense investing.
Yes.
Can you talk a little bit about what you mean by that?
Well, I mean, investing is not all that difficult. Essentially, you go and look around for things that are reasonably priced or inexpensive, and you try to avoid things that are expensive, whereby I consider that in a bubble like the NASDAQ bubble, 1998 to 2000, the NASDAQ became more and more expensive, beyond the rational thinking, or the same happened in Japan. So sometimes what is expensive will become more expensive before it collapses. But in general, common sense investing is essentially to look around the world, and if you have real estate and stocks and bonds and cash and commodities, something is always relatively cheap.
Does that mean that the man on the street sometimes is maybe better suited to make good investment decisions than the big experts?
I tell you, he's not sometimes better suited. He's much better suited than any banker or financial man because he has common sense. And you have to understand the individual in the street, he's not under performance pressure. The fund manager, if he's out of the market when the market goes up for 3 months, he loses his clients. If he's in the market when the market goes down for 3 months, he also loses his clients. So he has to be a momentum player. Whatever goes up, he has to buy. Whatever goes down, he has to sell. The man on the street, he can essentially run his business with common sense. And the worst people in terms of common sense and running the global economy are central bankers, notably Mr. Bernanke.
Now let me poke you in the ribs then on that one. Can you talk a little bit about the dollar and what's going on there?
Well, I mean, the dollar, as you know, has been weak since 1971. It's been in a downtrend. And then we had a pronounced downtrend 2002 to 2007. Because when global liquidity expands, the dollar is weak. Then 2008, global liquidity contracts and the dollar was strong. And since March of this year, asset markets go up again and the dollar is weak. And from what I read and from what I see, there's no intention whatsoever of US policymakers to do anything to stabilize the dollar. They'll continue to print money, and I think long term, my end value for the dollar is zero. Zero.
When is that going to happen? I mean, let me
not
ask
tomorrow, but obviously not
15 years,
tomorrow.
30 years, what are we
Well,
talking about?
I think in like 10 years, 12 years time, the US dollar will be like wallpaper.
Yeah. When is the U.S. dollar no
For
longer...
people who have bad taste, they use it as wallpaper.
When is the U.S. dollar then not the reserve currency anymore in the world?
Well, I think it's starting now that it loses its influence. A lot of people, the sovereign funds, they are concerned about their dollar holdings. The central banks in Asia are concerned about their dollar holdings. But it's not easy if you have $2 trillion worth of reserves to move it all out the next day. But basically the fact that since Christmas 2008, since the beginning of the year, commodity prices have gone up so strongly, like oil is up from $32 to $80, and other commodities have also doubled, like copper, is a sign that shows that the function of paper money, US dollars, as a store of value is no longer there. So people say to themselves, I'd rather keep my money in physical copper or in physical gold or in physical whatever it is, real estate or equities, than in US dollar cash.
Let me ask you this question. For the investor who has a large portfolio, wants to have a diversified portfolio, what's a general strategy that they should be looking at in the next 5 to 10 years?
Well, does he have a cash flow, this individual? How old is he? What is his risk profile? But in general, my view is that today, if I look at the world, we have the emerging market complex, the emerging economies. They have today higher car sales than the developed countries. They have a higher energy consumption than the developed countries. So in other words, as an economic bloc, they're no longer the poor cousin of the rich Western world. They have become very economically important. And so as an investor, for the equity portion you should have at least 50% of your equities money in emerging economies, including Asia, of course, part of it in Latin America. I think Brazil is really emerging as a very interesting long-term growth story. Also Africa and parts of Central Asia, the Middle East, Russia and so forth, and have less money in the developed countries' stock markets. And then I would have real estate in Asia, because the urbanization rate in Asia is very low. There's 700 million Indians that live in the countryside. There's still more than 700 million people in China that live in the countryside, whereby in China urbanization rates have gone from 29% to 44% in 15 years. So the people move to the cities, so you need housing, you need infrastructure, you need condo projects, you need shopping centers, and so forth and so on.
Yeah, great. Let me ask you this final question. You said that the so-called crisis, there's maybe some debate about that, but the last crisis was just a little appetizer for what's to come.
Correct.
What do you mean by that?
I mean that basically the sad part of the current crisis was that no problems were solved, but they were postponed. In other words, what led to the current crisis, namely excessive credit growth between 2000 and 2007, that hasn't been addressed. The private sector is withdrawing credit growth, and in the private sector, credit growth is now negative, but the government is coming in and pushing money into the system through the fiscal deficits and quantitative easing, and I think this will lead to another disaster down the line.
Now, Marc, I ask myself, what do you give the man that has everything? And I know that your reports are sometimes a little more gloomy and doomy than they are boomy. So I want to give you this little gift. Thank you for joining us. This little guy is called a Hoptimist.
Yes, Optimist.
That's
great.
He's a little piece of Danish design.
Okay.
That will hopefully
thank you very
help
much.
you be a little bit more optimistic in the future.
Thank you.
Thanks for being here. There you have it, a little bit from Dr. Faber, the inimitable Dr. Faber. This is Financial Friday for this week. We're coming to you from the Eurofinance Conference in Copenhagen. Thanks for being with us.